What if I told you your credit score isn't being destroyed by bad luck, or even by big financial disasters, but by 5 quiet mistakes you probably make without noticing? Mistakes that don't trigger alarms, mistakes that feel harmless, mistakes that can cost you tens of thousands of dollars over your lifetime. Here's the mystery. Millions of people work hard, pay bills, avoid obvious debt traps, and still watch their credit score slowly bleed. No warning, no clear explanation, just higher interest rates, denied loans, and missed opportunities. So what's really happening behind the scenes? To answer that, we have to go back to how the credit system was built, why it works the way it does, and how small actions snowball into long-term damage. The 5 mistakes I am about to break down, done to destroy your credit overnight. But once the damage shows up, it feels sudden and irreversible. Let's rewind. Setting the stage. How credit scores really work. Credit scores didn't exist for most of human history. For centuries, trust was personal. A banker knew your family. A shopkeeper knew your reputation. Lending decisions were slow, human, and subjective. That changed in the mid-20th century. As economies grew and lending went national, financial institutions needed a faster way to judge risk. That's when statistical credit scoring systems emerged. Systems designed not to reward responsibility, but to predict behavior. Your credit score isn't a moral grade. It's not a measure of intelligence or effort. It's a probability model. It asks one question. How likely are you to repay borrowed money on time based on past patterns? And here is the twist most people miss. The system doesn't just track what you do. It tracks how consistently and predictably you do it. That's where the 5 mistakes begin. Origins. Mistake number 1, missing small payments. At first, it seems harmless. A $15 subscription renewal, a forgotten utility bill, a medical copay you never knew existed. You think, I'll deal with it later. But the credit system doesn't see small, it sees late. Payment history is the single most powerful factor in your credit score. One missed payment can stay on your report for years. Not because the amount matters, but because inconsistency does. Here's the cause and effect chain. A bill goes unpaid for 30 days. It gets reported as delinquent. Your score drops, sometimes dramatically. Future lenders now see a pattern of risk. The irony? People with otherwise perfect financial habits often make this mistake because they assume the system will understand. It doesn't. The rise, mistakes say. 2. Using too much of your available credit. Now let us talk about something even more deceptive. You have a credit card with a $10,000 limit. You charge $7,000. You make payments on time. Sounds responsible, right? Not to the algorithm. This is called credit utilization, and it measures how much of your available credit you're using. High utilization signals financial stress, even if you're paying on time. Here's the cause and effect. High balances relative to limits. Algorithms assume cash flow pressure, risk rating increases, credit score decreases. What shocks most people is this. Your score can drop even if you never miss a payment. The system isn't asking, did you pay? It's asking, how close are you to the edge, and the closer you appear, the more you're penalized. The breaking point. Mistake. Number 3. Closing old accounts. This one feels responsible, even smart. You pay off a credit card you no longer use, you close it. You feel disciplined, but your credit score quietly takes a hit. Why? Because credit history length matters. The older your accounts, the more data the system has to evaluate your behavior over time. Here's what happens. You close an old account. Your average credit age shrinks. Your total available credit decreases. Your utilization ratio increases. Suddenly, your profile looks younger, riskier, and more volatile. without you spending a dollar. This mistake often shows up at a critical moment, right before applying for a mortgage, car loan, or business credit. The timing makes the damage feel sudden, even though the cause was months earlier. Fallout. Mistake number 4. Applying for too much credit at once. This is where urgency becomes dangerous. You want to refinance. You're shopping for loans. You apply to multiple lenders. Each application triggers a hard inquiry, a signal that you're actively seeking credit. One inquiry, minor impact. Several in a short period, red flag. The cause and effect looks like this. Multiple applications suggest financial strain. Algorithms detect increased borrowing behavior. Risk score rises. Your credit score drops. The paradox is cruel. The moment you need credit most is when the system becomes most suspicious of you. People often assume lenders understand context. They don't. They see volume, not intention. Failed fixes. Mistake 5. Ignoring errors and assuming accuracy. This may be the most dangerous mistake of all. People assume their credit report is correct, but credit reports are compiled by massive data systems, pulling information from thousands of sources. Errors are not rare. They're expected. Common issues include accounts that don't belong to you, late payments reported incorrectly, paid debts still listed as unpaid, duplicate negative marks. The damage compounds when errors go unchallenged. Cause and effect. Inaccurate negative data lowers your score. Higher interest rates follow financial stress increases. More reliance on credit begins. The system doesn't fix itself. Silence is interpreted as acceptance. Modern parallels. The pattern repeats today. Credit scores influence more than loans. They affect rental applications, insurance premiums, employment screenings, business opportunities. And here's the repeating pattern. People don't lose financial stability through one massive mistake. They lose it through small, compounding behaviors that the system magnifies over time. Modern data shows that even modest score drops can translate into thousands of dollars in extra interest over a lifetime. The system rewards predictability, not effort, not intent, not struggle, and it hasn't changed. Final takeaways. Let's bring it all together. Takeaway. For 1, credit scores don't measure responsibility. They measure consistency. Small lapses matter more than big intentions. Takeaway. For 2, the system penalizes behaviors that look risky, even if they're financially logical. Understanding perception is just as important as managing money. Takeaway. 3, most credit damage is slow, silent, and reversible. If caught early, ignoring it turns minor issues into long-term barriers. Your credit score is not fragile, but it is unforgiving. It doesn't care why something happened. It only remembers that it did. The real danger isn't debt. It's misunderstanding the system that judges you. So here is the question to leave you with. If your future opportunities depend on patterns you can see, shouldn't you learn how those patterns are formed? If this video helped you see credit differently, like, subscribe, and share it with someone who thinks their score is fine. Because the biggest credit mistakes aren't dramatic. They're invisible until it's too late.